Welkom bij een nieuwe aflevering van Goed Uitgelegd. Vandaag praten we met Evariest Callens, doctoraatstudent aan de faculteit Rechten. Evariest onderzoekt de rol van clearinghouses in de over-the-counter derivatenmarkt. Daarnaast schrijft Evariest geregeld over bitcoin en andere cryptocurrency. Je zal zijn stem waarschijnlijk herkennen, hij is namelijk een van de bezielers van deze podcast. Kleine disclaimer, deze aflevering is in het Engels, maar daarom natuurlijk niet minder interessant. Ben je geïnteresseerd in economie? Luister dan zeker naar onze andere podcastafleveringen, die je kan terugvinden op YouTube, Spotify, Apple Podcasts of je favoriete podcast-app. Zoals altijd, veel luisterplezier en hou je goed. Welkom Evariest, pursuing a PhD in law but with a high focus on economics. What led you to this interesting subject?
Well, my PhD is on capital markets law, with a focus on the infrastructure that we have in capital markets. And what led me to this topic or this venue is that I have an interest in economics. I have studied law, and what I like best or what I like most is the interaction between the two. Looking at the law from an economic perspective, so to speak, and I find it very interesting and intellectually stimulating to combine the two. So that's why I'm focusing on these topics.
So one of your papers is about the law and the infrastructure around cryptocurrencies, things like Bitcoin. Can you explain what a cryptocurrency is? I mean, we all have a vague notion of what it is, but...
Yeah, sure. So I would say during the last 10 or 15 years, we have witnessed in financial markets, but also outside financial markets, the emergence of cryptocurrencies and other what you could call non-traditional financial assets or non-traditional assets. And what makes these assets non-traditional is that they use certain technologies that we are not necessarily familiar with, or maybe now during the last 10 years we have become familiar with them. And it all concerns two basic technologies. One is cryptography, and the other is distributed ledger technology. And so if we talk about cryptocurrencies, you can hear in the word crypto that it refers to cryptography. And in a very basic explanation, cryptography is a technology that we have known for more than 1,000 years, and it's just a way of transferring information in a secured way via public messages. You encrypt a message or a coin that has value, and you can send it via a public medium. And it's only the recipient or the intended recipient that can unlock the message or the value.
So just to make sure I understand it correctly, Evariest, cryptography is basically what some of us did as kids, right? It's like the secret writing where you make up some writing and you say, okay, the letter A is transformed into a triangle, for example, the letter B into a rectangle, and then you just match the codes, and then the other person can decipher it. That's the idea, right? Just way bigger and digital.
Yeah. Roughly speaking, that is the idea. And of course, the concept that you are talking about, that would presume that we agree on a certain way of transforming letters into triangles or whatever. But the benefit or what we have been working with for the last 10, 15 years is a way that allows us to transfer indeed this information, but without having to transfer the code in advance. So you send a message that can only be unlocked by one person, but you don't have to transfer the code for unlocking it. It's only intended for one recipient, and this, of course, has is in terms of economics, is way more efficient, because if you also have to transfer the code for unlocking the message, it's costly, and you have to develop a secret code for every counterparty that you might be interacting with in financial markets. But indeed, the very essence boils down to what you have described.
And then the second technology that you mentioned was the distributed ledger. That's the blockchain, I think, in the case of Bitcoin. Distributed, that means it's not centralized.
Yes. And so just maybe quick note, blockchain is what we probably hear about the most, but blockchain is one sort of distributed ledger technology. So blockchain is the most well-known application of distributed ledger technology, but the more general notion is distributed ledger technology. And as you rightfully mentioned, Ben, it's a decentralized technology or a decentralized application. And what it essentially allows us to do, or maybe you can best compare it to a ledger, it's a ledger, a register that allows you to register information or transactions in which assets are bought or sold. And what gives this ledger a decentralized nature is that instead of one central entity controlling the transactions and verifying the transactions, it's basically everyone that is participating in the system that controls the transactions and verifies whether the person who claims that he had an asset or had a coin and has transferred it indeed had the asset.
So it's basically one big book where everybody can write in the transaction, and if everybody else agrees that this transaction is valid, then we say, okay, this is correct.
Yes,
this is right.
Exactly.
But it's not one book, right? So you have normally you would have one piece of paper, one book where you write every transaction. So Evariest transfers a Bitcoin to Ben, transaction 1, transaction 2, Ben transfers it further to Arthur. That's one book, but it's distributed. So if I understand it correctly, every person in the system, so everyone participating in Bitcoin, I guess, has his own book, and a transaction is only valid if all these books match. That's a distributed register or ledger, right?
Yes, exactly. So everyone maintains a known copy of the book, and every time a transaction occurs, everyone has to update the book, and everyone can verify whether the new transaction matches with the previous transactions. So maybe to sketch the idea or make it more concrete, if we were just to set up a payment, if I were to buy some goods from you, Ben or Arthur, you could pay me in cash, and then it's easy. If you transfer me the cash, it's clear for everyone that the cash is now in my hands. If we look at a banking system, at the financial sector, we have the bank, who's basically an intermediary and always controls if I execute a payment, whether I actually have the money in my bank account, and most importantly, whether I don't spend this money twice. If there were no bank, I could spend the money twice. Of course, it's very... maybe it's weird to think about it in that way, because we're so used to having a bank controlling whether we not spend money twice. But it's very important. And in the literature, it's known as the double spending problem. And this is actually the very core contribution of distributed ledger technology to the financial sector, that it allows you to control whether a certain coin has already been spent by someone who claims to own the coin or not. So, and that is where it contributes value, or could contribute value to the financial system, that it would allow to cut out intermediaries such as banks.
But does that then mean that the banknotes, we have the 10 euro bills, they have some sort of serial number on it that's unique to that note? Is that similar for Bitcoin? Because otherwise, how can you verify if a coin has already been passed around multiple times or one time?
Yes, it also. I'm not an expert in the real technology. I look more at the legal side of things. But indeed, every coin has a certain stamp that allows you to identify who it belongs to. But every time a new transaction occurs, I think it receives a new stamp. But still, it allows you to trace back the history of transactions.
Okay, so if we look then more to the legal side, who guarantees that I'm able to pay in Bitcoin? Because for normal money, normal cash, we have either the banks or the governments that issue the cash, and they say, yeah, we accept that you can pay taxes in this money, so it's valid at least for that, and then everybody else can build on top of that. But how does that work for Bitcoin?
Well, actually, it's entirely different for Bitcoin. As you rightfully mentioned, with euros or dollars, you will also always have a government that will accept your money. And it's important to mention that from a legal perspective, for instance, in the Eurozone, you have a legal obligation if there, for instance, if I have lent you money, Ben, and you want to repay me and you offer me euros, I have a legal obligation to accept the euros. But you cannot force me to accept anything else. If you want to pay in Bitcoin, I can say, I'm not interested in your Bitcoin, I want euros. And so that is a different, that's an important legal distinction between Bitcoin and, well, actually between legal tender, which is euro in the Eurozone, so just regular currencies, and all other assets. If you want to pay me in apples, gold, bananas, or Bitcoins, I don't have to accept it. I may accept it if we contractually agree, or if I just accept if I'm interested in your Bitcoins. There's legally no problem for me to accept it as payment, but you cannot force me. And that is a critical distinction. And of course, as you have mentioned, an important one is also the government will definitely never accept, or at least right now, for the moment, will not accept Bitcoin as a payment if you have to pay taxes, or if you, if you have been fined, you will not be able to pay in Bitcoin. Government will only accept euros.
Does this relate to the distinction you make in your papers between intrinsic value and extrinsic value?
Well, it's somehow related, but from a legal perspective, money is an interesting case. In that, or is a bit peculiar in that money is actually, theoretically, from a legal perspective, is a claim on the government that, or on the central bank that has issued the money, but that is only in theory. You can never exercise the claim, so you can never go to the government and claim gold or any other assets in exchange for your euro note. But what you mentioned, intrinsic and extrinsic asset value, those are notions that I use in my paper to single out Bitcoin and other financial assets that are similar to Bitcoin. And basically, my claim is that this type of assets, that it only has extrinsic asset value. And what I mean with that is that certain goods, certain products, assets have a certain functionality, food, clothes, gold. You can use them even if there is no one in the whole world that is willing to purchase them from you, to pay money for it. So they have a certain intrinsic value. But then you also have, if there is a market for a certain good, for instance, gold, people might be willing to buy gold from you, not necessarily because they think it has an intrinsic value, not necessarily because they want to make gold rings out of it or use it for whatever application gold might have, but just because they expect that the value might rise in the future. And this is what I call extrinsic asset value. That is the asset value that an asset derives from other people or entities in the market that want to pay you money for your asset. And why I think it's important to make that distinction.
Before you go there, so what about normal cash money? Because, okay, a 10 euro bill, I can maybe use it to draw stuff upon or like take notes on it or like square a table. But apart from that, it doesn't really have any useful value, so any intrinsic value. But then you mentioned it's theoretically a claim on the government's gold. Is that then the intrinsic value of money, or?
Well, it's not a claim on gold of the government because you can never claim gold. It's just in theory, from a legal perspective, it's a claim, but you cannot enforce it. So that's why I'm a bit reluctant to compare it to Bitcoin, because it's a bit peculiar from a legal perspective. But as you're correct if you're stating that money, a euro note, as such doesn't have any intrinsic value in that it allows you to have any functionality. The value that you derive from a euro note also largely exists because other people will also be accepting euro notes. So it's basically a social consensus. As long as everyone accepts euros as payment, you will be able to purchase value in the economy, purchase goods or services. And in that respect, there is a similarity between Bitcoin and money as we currently know it. Of course, with the very big difference that euros or dollars are issued by a state or by a central bank, and that there are certain mechanisms in place that seek to guarantee that there's stability in the value of the coin, which of course is currently not the case for Bitcoin or other cryptocurrencies.
Okay, so from an economic point of view, the distinction, or why you make the distinction between intrinsic and extrinsic is quite clear, because it's two additive types of value. Why, from a legal perspective, why is that important?
From a legal perspective, it is important because traditionally, and this is the thesis that I seek to develop in my paper, so I wouldn't dare to claim that everyone would agree, but the thesis that I develop in my paper is that traditionally in European financial law, as well as in Belgian financial law, which is largely based on European financial law, that most of the legislative acts that we have look at or are targeting financial assets that do have intrinsic value. And so if we can agree on that point, and that's the point I try to develop in my paper, then the conclusion is that Bitcoin and other assets that are similar to Bitcoin that do not have intrinsic value fall entirely beyond the scope of European financial legislation. And that is, of course, an important point, but because if that is the case and we think it's dangerous for one reason or another, then there needs to be a legislative intervention. Then the European or the Belgian legislator needs to draw up new legislation, because the legislation that we know for financial instruments or financial markets as such only looks at assets with intrinsic value.
So wait, that means that all the rules we have on shares or on bonds or trading of shares and bonds, all those rules we developed over the past years, decades, those are all not applicable to Bitcoin and to cryptocurrencies as the laws now stand.
Yes, that's correct.
Okay.
And so what you mentioned, the laws that look at shares and bonds, there you see shares are basically a company issues shares, and that means that you give some of your money to the company, you get a share in exchange, so it's used to finance the operations of a company. But you clearly see that you have two entities in that story. You have a company, and then you have the shareholder. For bonds is the same. You have a bondholder, and then you have the company or the entity that has issued the bond. And that is one type of intrinsic asset value. You have a certain, I'm gonna not go into the legal terminology that I use in the paper, so maybe it's a bit inaccurate from a legal perspective, but you can think about it as a contract. You have two entities contracting with each other. There will be rights and liabilities in that relationship. And this very essence of shares or bonds or traditional financial instruments to which traditional financial legislation applies is absent with Bitcoins. Because if you own a Bitcoin, you have a Bitcoin, and your hope will be that someone else will be purchasing your Bitcoin in the future for a higher price, but you cannot force anyone to accept your Bitcoin, or you cannot force anyone to provide any services in exchange for that Bitcoin, which is different if you have a contractual relationship, for instance, between a company and a shareholder.
But why is it important? And so if Bitcoin does indeed fall outside the scope of European financial, and maybe American as well, regulation, why is it important that we regulate it? Because as long as you and I agree, and we have certain understandings of how this ledger works and the cryptography works. Why should it be regulated? It's two consenting parties.
Yeah, that's a very good point that you make, Ben. And just to be clear, in my paper, I don't make any big claims on whether Bitcoin or other cryptocurrencies should be subject to specialized legislation. But I think the argument that has been developed and that regulators and legislators are developing is that indeed you could take a liberal stand and say, well, it's two consenting parties. What do we care? What is going on in these markets? But there is some concern about the protection of financial consumers. And there is concern that actually big players in the market for cryptocurrencies could be manipulating these markets and could push up prices artificially. And then when prices are at a high point, exit. And then the smaller guys like you and me are still in when the prices are going down, and we have to take the losses. So that is one of the concerns.
So that means that the regulation kind of makes sure that this implicit understanding between all parties stays valid.
Yes, exactly. The regulation, or regulation, if it were to be introduced for these markets, would try to make sure that the rules of the game of buying and selling these cryptocurrencies are well known for everyone, and if people try to violate these rules, that they will be punished essentially.
So maybe going forward on that, do you think? I mean, you sound pretty positive about cryptocurrencies in general, about Bitcoin. Do you think Bitcoin could eventually replace the money we use? That we will be paying for everything with Bitcoin instead of with euros or dollars or other currencies?
I don't know whether I'm necessarily positive. Like maybe I'm just if I'm talking about the law, I take maybe a more neutral view with respect to the question of whether it should be regulated. Because if I want to take a stand on that, I would have to do more research into the excesses or the abuses, and I've more looked at the existing financial legislation. But to answer your question, could it replace existing currencies? Cryptocurrencies and decentralized applications in general definitely do have their merits and do have potential. Bitcoin, I think, is way too slow to process large transactions or a lot of transactions. So Bitcoin is not really I think viable to replace payment mechanisms that we know in the financial sector. But you have many what we call altcoins, alternative coins, that are way faster than Bitcoin, and so maybe are from the perspective of the technology are more viable as replacements of existing currencies. But for me, and maybe I'm a bit cynical, but for me the capital question is whether existing governments or central banks will be willing to adopt these new technologies, because of course central banks and governments have a strong incentive to not facilitate private cryptocurrencies, because it might interfere with their policies, not in the least with monetary policy that they are conducting. So I think it will largely depend on the approach that central banks and governments will take towards these currencies, and that is ever evolving. But for the last couple of years, we have seen actually a pretty strong crackdown on private currencies. So yeah. We will have to see how that evolves.
If we take a more economic point of view on the Bitcoin, the way I understand it is that to obtain a Bitcoin, you can either buy it for, I think the shares are now at some record high or something like that, or alternatively, you could mine it, which is putting on your computer and let it run day and night, some sort of very complicated algorithm, and at the end of the calculation you get 1 to I don't know how many Bitcoins, and one of these special things about this algorithm is that the more Bitcoins already are mined, the harder it gets to mine one additional one. So it's an increasing marginal cost. But doesn't that mean that there's some sort of upper limit on the amount of Bitcoins that can be mined?
Yes, that's, well, I don't know whether that follows from the technology or that it becomes harder, but Bitcoin has just been programmed that it's capped. There's a maximum, I think it's, I might be wrong, but 21 million. So at a certain point, all Bitcoin.
You mean 21
Bitcoins,
million
yeah.
Bitcoins, not 21 million euro worth in Bitcoins.
Because the value of these Bitcoins fluctuates and depends on the market demand and the market supply. But there's a cap on the number of Bitcoins, and that has just been designed. It's not inherent to cryptocurrencies that they are capped. You can also think about other assets in the crypto sphere, such as Ether, and there you have it's uncapped, or there's a cap per year. So every year there will be more coins in circulation. But of course, from if we think about it from an economic perspective, the fact that Bitcoin, that there's a limited amount of Bitcoin, creates some, I would say, captivating questions in terms of monetary policy, because if the economy grows, you want to have more payment instruments that you can use in your economy, and this would be impossible with Bitcoin. So
it seems like something that history already went through with the gold standard. The amount of gold in the world is limited as well. Okay, maybe we don't have everything yet, but I mean, Earth's resources are limited, so ipso facto the amount of gold as well. And then in the 70s we said, this link between money and gold maybe not that good of an idea because it limits the growth of the economy. Is that applicable for Bitcoin as well, or?
It's indeed it's comparable to the gold standard, and of course, we might still discover new gold mines. And for Bitcoin, it's certain that we won't discover any Bitcoin mines. But from a practical perspective, yes, it's similar, and it might not be ideal. But again, it's not inherent to cryptocurrencies. We could easily design cryptocurrencies that we, for example, connect to inflation, and we could think about ways to not make it problematic, I think.
So I understand that it's not an argument against cryptocurrencies as such, but it is a strong argument against Bitcoin, right? Because as I understand it, Bitcoin is inherently deflationary in the end, because once you reach the maximum amount of Bitcoins, and you have more economic activity where you need Bitcoins, the value of these Bitcoins will increase, so your prices will drop. So you get deflation in your economy, which is not very interesting, as we've seen in history, right?
Yes, exactly. Yeah. Once you reach the cap, the value of your Bitcoins, at least if the assumption is that your economy is growing, then the value of your Bitcoins will go up, and that's indeed deflation, and that is not something we desire, I think.
And maybe another point we can look into when it comes to Bitcoin specifically. I mean, Bitcoin is probably the most widely used cryptocurrency at the moment. I mean, we hear a lot of stories. I think currently the big story is in Iran, where they have a lot of computers mining these Bitcoins, where they have a huge growing issue actually when it comes to the need for electricity. I think one of the numbers that was mentioned is that for the transaction of one Bitcoin, so for one transaction that is registered on the blockchain, you need the amount of electricity that an average family would use in 72 days for one transaction, which also sounds like a big downside of Bitcoin, right?
Yes, exactly. So I wasn't familiar with the exact numbers, but I know it requires a lot of electricity or power, and so it's not guys like us with our laptops who will be mining Bitcoins. It's actually, you have, I don't know how they I think like Bitcoin farmers, or it's like basically almost factories with computer power where they are mining for Bitcoins, because of course it's depending on the price of Bitcoin, but I checked right before we started this call, and it was $32,000 per Bitcoin. So it's depending on how much electricity you use, it can be quite profitable to engage in that activity. But I was actually told that the fact that it requires so much electricity or power is also related to the security of the transactions and of the distributed ledger. And so Bitcoin is pretty slow, but people tell me that it's still the most secure type of cryptocurrency. And so you can make it cheaper in terms of electricity use. You can think about faster applications, but I think that will be inversely related to the security of the transactions. So, yeah.
So maybe to sum up your views on Bitcoin, looking at the downsides and the advantages, would you say it is a currency or could be used as a currency, or is the current hype simply a speculative bubble where the price of Bitcoin simply goes up because more and more people want to buy Bitcoin, just like what happened with tulips and the flowers in the Netherlands a couple of 100 years ago? Is it simply a speculative bubble?
Well, whether it's only speculation, I think there's, maybe first to answer your first question, both from an economic and a legal perspective, I don't think it qualifies as a currency right now. Its most important argument would be that it does not retain value over time. And that, from an economic perspective, is something that we consider necessary for a currency, and also to a large extent, depending a bit on the theory that you're looking at from a legal perspective. So if you have €1 or €2 today, you know that you will be able to buy a bread in the bakery, and tomorrow it will be pretty much the same. You will still be able to buy your bread. But if you have one Bitcoin today, it might be that the value of your Bitcoin has decreased by half tomorrow, so that you will only be able to buy half a bread. And so that is a property of Bitcoin or many of these cryptocurrencies that bars it from being perceived legally and economically as a currency. Then the second part of your question, is it purely a speculative bubble? I think, if I talk to people, there's many people out there that really believe in the potential of cryptography and distributed ledger technology. But to be honest, and as I mentioned earlier, I think it definitely has value. But right now, Bitcoin and other cryptocurrencies, in the narrow sense of the words, I think most people, there's hardly any people that see it as or buy it because they think it will be a viable currency for executing payment transactions. People buy it because they see it as an investment. I could buy one Bitcoin today, but the only reason I will be purchasing it is because I think you guys will pay me more tomorrow. And so from that perspective, it's treated as an investment, and to a large extent, it's speculation, because it's largely disconnected from the underlying functionalities that these coins might have. And that also ties in with what you asked earlier, Ben. What are the concerns, or why should we regulate this? The point is, of course, if people start to speculate on these coins, and there's because for me that would be a major concern if I would or were to invest in these markets. I would be concerned that other people are manipulating the markets and manipulating prices, and then of course, if you invest in cryptocurrencies, there's one thing that you can be sure about. There's a lot of risk, which means that prices will be fluctuating a lot. And so if you like a very high risk exposure, it's something you could consider. But I would always be aware that there might be people in the market that have superior information or that are actually manipulating the prices to your disadvantage. And for me, that would be a big disadvantage or an argument for not investing in it.
So it seems Bitcoin is mainly an investment vehicle, not so much yet a reliable payment mechanism. Well, something else that's at least interesting and maybe even educational is the technology underlying it and the cryptography and the decentralized ledgers, even if we don't use it as Bitcoin. I remember about a year ago, maybe, Facebook also made a move in the cryptocurrency world by introducing the Libra. Is it something similar as Bitcoin? Because it also seems like a cryptocurrency. It's only virtual. It's private. It's not backed by government yet. Is it the same?
Yes. No, it's not the same in the media, and it's often mentioned in the same sentences. And I think a lot of people, even regulators, look at it as a bunch of the same things. But from both an economic and a legal perspective, it's fundamentally different in that what Libra actually does. So Libra was indeed, I think, launched in the summer of 2019, or the white paper, the ID for a Libra was launched. And what Libra actually wants to do is, rather than just issuing a coin that is not backed by anything, what Libra does, it's also a coin, but there is assets behind the coin. And so you can always exchange, or that is the idea, you would always be able to exchange your Libra coin for the assets that are behind the coin. So there's basically a basket of regular currencies, euros, dollars, pound sterling, or even some low-risk financial assets, so government bonds. And the idea is that you then create a sort of private currency which will have a much more stable value, because you know that you can always exchange it against these currencies. So the price is not going to go up, because everyone knows exactly what the price is, what you can get from this fund, basically, that is behind the coin. So it has much more potential, I think, to exactly solve this issue that we were talking about earlier, that Bitcoin has, that your prices are fluctuating over time. This would be not the case with stable coins. That's exactly the name. Stable coin means we are stable, or trying to stabilize the price of the coin, which makes it much more viable as a payment for payment instrument.
Okay, so Facebook designed it specifically to facilitate transactions, probably on their platform.
Yes, firstly. And of course, it's of course a smart move, because if you design a private coin and everyone starts to use it for payment, to execute payments, then you obtain all the information that is connected to these payments. You know what people are buying and selling, and it's of course a huge advantage for big tech companies. And I think governments have also realized that Libra and other stable coins might actually be much more dangerous than cryptocurrencies in the narrow sense of the word, such as Bitcoin, exactly because it's much more viable as a currency. And we have seen it in the US that there was a heavy crackdown on Libra, and actually it was not only issued by Facebook in the beginning. There was 60 or 70 big companies, also Visa and other players, MasterCard. But once there was once the regulators started to scrutinize it, many of these companies backed out, and now Facebook, they have adjusted some of their plans. But I think this is also something that central banks or governments will be looking into to develop themselves.
Maybe, Evariest, to take a quick jump at the question many listeners are probably having in their heads for the past minutes and for the past more than half hour already. Have you already bought any Bitcoins?
That's an interesting question, Arthur. It's funny because I know you know the answer, but the audience does not. No, I personally do not invest in cryptocurrencies. The fundamental reason is that although I believe that there's value in the technology, there's very little assets or real value that is backing these currencies. And so although they, even if you're expecting that they might go up, it's probably because other people are speculating on the coin as well, which is different, of course, if you invest in stock markets where, on average, stock markets will also go up. But you know that there's assets behind it, and that gives you maybe some sense of security, or a sense of security that I like. And so that's why I'm not investing in these cryptocurrencies, because there it's less clear to me what the value is that is behind these coins. And a second major concern that I have, and that we have already touched upon, is that I would not be surprised if there is market manipulation in these markets. And I don't like other people taking advantage of me. So no, I do not own Bitcoins or other cryptocurrencies.
Okay, no, that's a very clear answer. So aside from Bitcoins, you're working on your PhD. So maybe we can segue into the second topic of today, which is mainly on your central topic in your PhD. And I'll sum it up in one sentence. It is about the role of CCPs in markets for OTC derivatives. Now, I think there's a lot to unpack there. So maybe we'll zoom in on each element of that, just to make sure everyone understands what we're talking about. So it's about derivatives to start with. What's a derivative?
Yes, Arthur. There's indeed a lot in that one sentence that you have there. A derivative, in very basic terms, is a contract between two parties. So it could be you and me, or it could be two big banks, more likely. And it's a contract that is specifically designed to transfer risks. So it basically allows financial institutions to buy and sell very specific risks. So it allows to detach risks from certain economic operations and sell those risks to other entities that are maybe better positioned or more willing to carry these risks on their balance sheets. And so that's from a functional perspective, that is what a derivative is. A complex contract that allows financial institutions to transfer risks.
So an example of that would be if I think the first type of derivatives were like grain derivatives or something like that, like something that to do with farming, where, for example, a farmer wants to sell, 100 tons of grain when his harvest is done, but he doesn't know what the price for grain will be in half a year time. So what he does, he already sells the contract to be able to sell a certain amount of grain at a certain price to then, some buyer who's willing to buy this contract, who can then say, okay, the time has come, now you have to sell me this amount of grain for this amount of money, regarding what the price on the market is at the moment. So
yes.
Is it something like that?
Yes, exactly. And there's many different ways in which you could structure it legally and from a technical perspective. But the very essence is indeed, as you rightfully point out, for instance, and we have known derivatives for thousands of years, especially in the context of agriculture. You can use it to lock in a certain price if you, it's the beginning of the year and you don't know what the weather is going to be. So it might rain a lot, it might not rain a lot, and that has an impact on your production. Then a derivative contract will allow you to lock in a certain price that you will obtain in the future for your products. And so basically, one way to look at it is that you transfer, or that is functionally what you're doing. You're transferring the risk that, if there's not a lot of rain and your production is poor, that you will not earn a lot of money. You're transferring that to a bank, and the bank is, of course, willing to take that risk, because the flip side of the coin is if there's a lot of rain and your production exceeds expectations, then you will still get the fixed price from the bank, and the bank will get the upside of the overproduction.
So in our current example, the farmer is protected against a price drop
Yes.
The buyer is protected against a high price rise. Price rise. In this,
the bank who is selling the derivative basically will reap a product if the prices are higher than expected.
So if I understand it correctly, the essence of derivatives, which also gives it a name, is that derivatives are always derived from another contract. In this case, it's the sale contract of grain, but it could be a loan that a bank gives to a person to buy a house. So you always have an underlying asset, be it a loan, be it the contract, and then derived from that, you have other things which are the derivatives.
Yes, exactly. That's where the word comes from. From a legal perspective, it's a bit more complicated, or at least that's an argument I develop in my dissertation, that the definition that you have given, which is the definition that is always quoted, is not really accurate, but I won't bother the audience with my arguments for that. But I think indeed, the dynamics are like that. You have two contracting parties that are facing each other. They have a different perspective on a certain underlying element or event or parameter, how that will fluctuate. And so from a functional perspective, which is again not a legal perspective, that story is more complicated. But from a functional perspective, you could actually compare it to a bet. If you bet with another person on a certain event occurring or not, it's pretty similar to that. You take different views with respect to the underlying event. Will my soccer team win tomorrow or not? You say yes, I say no. We say okay, let's see. We'll bet for we'll make a bet 50 euros on it. That is from a functional perspective. That is what derivatives do too.
Which is a useful function, I get, right? Because in the example of the farmer, I mean, the farmer wants to sell his grain to the companies taking his grain and making bread with it. But he says, okay, if the weather is bad, I don't have a lot of grain, I won't earn a lot of money. But the bank thinks, okay, but what if you do have a lot of grain and you do earn a lot of money? And then the bank basically, the farmer basically says, okay, I'm giving my grain, the bank is giving me 100 euro for the grain because I fear I might only get 80. But then what you're saying is the bet of the bank side is no, the grain will be 120. And then we will pay 100, but we will get 120.
So the bet is on the production of
on the risk.
Of the amount of, or the risk,
Yes,
okay.
yes, exactly.
So these derivatives, I mean, I've never encountered them in my real life. I don't get paid in derivatives or I don't buy them or anything like that. Is it big business?
Yes, it's super big business, and it's interesting because indeed, wherever I go and I talk to people about my research, people are like, "What derivatives? What is that? I don't know that." It's maybe they assume it's irrelevant, but it's super big business. If you look at the numbers. These are estimations, but the notional value, and we can, for different reasons, it's maybe not the most accurate lens to look at the market value of derivatives, but the notional value, to just drop the most impressive number, exceeds 600,000 billion US dollars. Which
600,000 billion.
Yeah, exactly. So that is, I would say, almost unimaginably large. But I must immediately say, now that I have mentioned the most impressive number, that's actually the number that is used. I don't want to make the story too complicated, but for the calculation of the payments that might result from the derivatives, the money that will eventually change hands is or the amount is way lower, is more 10,000 billion US dollars, but it's still extremely significant. But then to further boil down the impressiveness of the story that I'm trying to sell here, there's of course different techniques that you can allow that you can use to reduce the risks that are connected to these contracts. And that is actually what my PhD research is about one of these techniques that allows us to, because 10,000 billion US dollars, there's...
10,000 billion, that's a a 1 with
That's quite some money.
13 zeros. A billion is 9, and then 4 other zeros. Yeah, that's quite a lot of money.
Yes, it's yes. Well,
in comparison for the listener, what the Belgian economy produces in a year, so everyone in the whole Belgian economy, what they produce in a full year is 400 billion, more or less. And this is 10,000 billion. So that's quite a lot of money.
The total value of money that changes hands through derivative contracts or of derivative contracts that are outstanding that still need to change hands, because every time a contract is paid, that it's reduced from that number, but the outstanding amount equals 20 times, roughly speaking, Belgian GDP. So it's super significant.
And that includes, I guess, derivatives of derivatives. You can do that.
Yeah, you can do that. So essentially, derivatives, as we have been talking about, it doesn't need to be too complex. It's a contract that allows you to transfer risks, but you can, and you have different ways to structure it, but you can make it extremely complex. You can make derivatives of derivatives, or you can include formulas for payment that you can only understand if you have a PhD in mathematics. And I do not claim that I understand all these transactions, definitely not. But in their very essence, they can all be traced back to very basic building blocks that are of the structure. If something happens, then money will change hands. You will pay me or I will pay you.
Okay, so moving on then to the next step, you mentioned these OTC derivatives. OTC, it stands for over the counter. What does that mean, over the counter? It sounds like something at a supermarket or something, or an apothecary. Like over the counter medicine is also a thing.
Yeah, indeed. It's and it actually refers to that notion. Over the counter literally means that these derivative contracts that we have been talking about are concluded, so initiated, set up over the counter. So at a table, so to speak, two parties in private. Of course, we're on a call now, but if we would be in the same room, it could be you and me, Ben, at this moment that we agree we are going to set up a derivative contract at this counter, over the counter. We are going to determine the terms and we're going to sign it right here.
And that stands in contrast to derivatives not agreed on a table, or like what's the non-OTC version?
Whether they are concluded at a table, that it's the idea is that over the counter is at a private table. So it's just you and me, and no one else needs to know what we are doing there. And it stands in contrast to derivatives that are initiated at public markets. So as with stock shares, you have stock exchanges where you can just go and buy stocks, but that if you buy stock at a stock exchange, what actually happens is that you are purchasing it from someone else that you don't see, who is selling it to you, but there's basically interaction between many buyers and sellers, and that process determines the price. And so for derivatives, we might also, there are exchanges for derivatives where the price of the derivatives is determined by the interaction of many buyers and sellers. And so over-the-counter derivatives are not concluded on those exchanges or just in a private room, you and me.
So a normal derivative is something that's public and more or less standardized. There are probably 100 million different flavors for types of derivatives, but they're well known. The terms and the specificities are public to anyone. The over-the-counter ones, that's just between two consenting parties. Sounds like Bitcoin,
yes. Well, no, because if you compare it to me buying your Bitcoins, then yes. But if you just if I'm just owning my Bitcoins and I'm not engaging in any transaction, then there's no counterparty. So from a legal perspective, it's quite distinct, Bitcoin from derivatives. But one thing that I want to clarify, you call the derivatives traded on public markets, exchanges, the normal ones. But actually, throughout history, we have seen that the value of the over-the-counter derivatives, so the privately negotiated derivatives, exceeds the publicly traded derivatives. So from that perspective, you could probably say that OTC or over-the-counter derivatives are the normal ones, and the publicly traded, they are at least the smaller group.
Okay, so maybe to jump back to that sentence of your PhD, where you said the role of CCPs in markets for OTC derivatives. So now we basically know what derivatives are, financial contracts derived from underlying assets. For example, the grain producer, it's OTC, so over the counter, in contrast to the exchange traded derivatives. But now your PhD specifically is about the role of CCPs. But what are these CCPs?
Yeah, is it like the Chinese Communist Party or?
Yeah, that's actually funny, because if you do research into CCPs, then you always bump into these articles that are on the Chinese Communist Party. So it makes research harder, that's for sure.
So it has nothing to do with the Chinese Communist Party.
No.
Okay.
No. I guess the Chinese Communist Party might also be engaging in derivatives, but on that I have no data and I will make no further claims. But in my research context, CCP stands for Central Counterparty.
Central Counterparty,
so
CCP.
Central Counterparty, CCP. And so a CCP essentially is so we have talked about these derivatives and the enormous value that these contracts have. And so one risk that exists is if you and me, or Ben, Arthur, if we set up derivative contracts in private, these values might be, or the payment obligations that arise from these contracts might be very significant. And so the risk that comes into existence, if you guys need to pay me a couple 100 millions or billions even under these contracts, and you guys go into default, go into failure, and cannot pay me, I'm facing a big loss. And there are different legal techniques to mitigate the risk that such losses may occur. And we call that risk counterparty risk. So the risk that your counterparty, with whom you have set up a derivative contract, will fail to make good on the contract, will fail to make his payments or her payments. And one of the techniques is the CCP, the Central Counterparty. And in its very essence, what the CCP does, the CCP is a company that puts itself in the middle of every transaction. So instead of you and me contracting, I will be now contracting with the CCP, the Central Counterparty. That also explains its name. It's central to the pre-existing transaction. And the CCP will then be contracting with you guys. And so what functionally happens is, if you guys cannot pay me, the CCP will have to pick up the bill, because you have now a contract with the CCP and not with me. And so if you guys cannot pay, the CCP will face losses, but I will not be directly affected, because the CCP will still be legally obliged to pay me. And why have we come up, or that's in the very essence what a CCP does.
But what if the CCP goes under?
Yes, that is of course the big question, or that is a very good question. What if the CCP goes under?
Maybe quickly, to make sure I understand it correctly. So you are selling an OTC derivative, and normally you're selling it to us, or you're selling one OTC derivative to Ben, you're selling one OTC derivative to me. But instead of this direct transaction, you have this person or this institution in between, which is the CCP, and you're not selling the OTC derivative to us, you're selling it to the CCP, who is buying it from you, and then the CCP is selling it to us, and we're buying from the CCP. That's how it works. So you have one institution in the middle, right?
Yes. Well, okay. For all practical purposes, yes. From a legal perspective, we initially will still set up the contract. And so it's in a second step is the CCP breaks up the contract and comes in between.
Okay. And then the question is, okay, if we go bankrupt and you're selling to us, you have a problem because we won't be paying you. This is avoided because you're selling to the CCP. But then what Ben said is, yeah, but what if the CCP goes bankrupt and you have all these persons selling to the CCP and all these persons buying from the CCP? That sounds like a concentration of risk, right? It sounds riskier.
It is definitely a concentration of risk. Whether it's riskier, about that I'm not sure. So what actually happens is the assumption is that if we are engaging in derivative transactions, I am taking risks, you are taking risks, but the CCP, since it stands in the middle of every trade, as long as no one is of the members of the CCP is failing, the CCP is not taking any risks, because if it loses on one contract, it will win on the other contract. If the CCP has to pay me money, it's receiving its money from you guys, because we were initially engaged in this contract. So as long as no one is going into default, the CCP is a zero-sum operation. It's just transmitting money from people that are out of the money to people that are in the money on these derivative contracts.
But that means that if it's a zero-sum game, that if somebody goes bankrupt and the bill goes to the CCP, that they don't have any additional money to pay it with.
Exactly.
Because it's a zero-sum game.
Exactly. As soon as someone, as one of the members fails, there's the matched book, as we like to call it, of the CCP is distorted. The CCP faces a deficit because it still needs to pay me, but it's no longer receiving money from you guys. And therefore, the CCP has some own financial resources, so capital, but the most important way in which CCPs may fund the losses from you guys no longer paying to the CCP is that everyone that uses the CCP to clear their derivative contracts, everyone basically contributes financially to the CCP in what we call a default fund. So basically, it's a risk-sharing mechanism rather than, the CCP itself is backed by all the members that use the CCP. And so if you guys can no longer pay the CCP, everyone else that is using the CCP, if there's sufficient losses, will be participating in the losses. So the CCP technically picks up the bill, but it's the members who are using the CCP who are funding part of the bill.
It's a bit of a cooperative society, like the...
Yes, yeah. Actually, yeah, it's a corporation, and it's a nice way to think about it, Arthur.
Can you say that, okay, I don't want to go through the CCP because I don't have a risk, or I'm very confident I will not go bankrupt, so I don't want this risk mitigation party to take some of my money because it will not be applicable to me anyway? Or are you forced to go through the CCP?
It depends on the contract. For certain contracts, you are not forced. If the contract is really bespoke or individualized, if we make up a weird contract that is super technical, we are not obliged to go through the CCP. But if we use a rather standardized contract with standardized contractual terms, there is a regulatory obligation for you to use the CCP. Would not apply to us because we are small guys, but for large financial institutions and large corporations, there is an obligation to use the CCP. And maybe it's important to, because we haven't mentioned that, the idea, of course, behind the CCP is that if you pool all the financial resources of all the members in the market, that it's more likely that the failure of one financial institution will be stopped or arrested before it spreads like a domino effect through to the other members in the financial system. And so that is the assumption on which the CCP builds.
So if everybody pays up a little bit money in advance, then we can more or less prevent that if one goes bankrupt, then the CCP will say, okay, no, we will we will not prevent the bankruptcy, but we will prevent it spreading to all the others.
Exactly. So, for instance, if I'm just contracting with you, Ben, and you owe me $100 million under a derivative contract, which is not the case, if you were to go into default and it's just an OTC, purely OTC, over-the-counter derivative contract, I would lose $100 million. But if we put the contract through the CCP, and there's 100 different members participating in the CCP, everyone is basically going to lose $1 million. And the idea is that then it's less likely that other financial institutions will also go into default.
I mean, it sounds good indeed when things go bad and everyone is acting in good faith, but things do go bad, you kind of share the risk. But what if, I mean, isn't there a risk of moral hazard as well? What if there's a bankster in there who's thinking, okay, I just want to make big money, I'm going to take huge risks, and if I fail, we're all sharing the losses. So isn't there a big moral hazard there as well, that people will be taking more risk, which actually increases the general risk in the system instead of decreasing it?
Yes, there's definitely a potential risk of moral hazard in that indeed. If we set up a contract, you and me, Arthur, I know that if you're going to engage in risky activities, I will have to pay the bill, because if you go into default, I lose my money. So it's very clear. If you're being too risky, I will either not contract with you, or I will charge you an excessive fee. I will charge you a high price that covers up for the risk that you go into default. But if we put the transaction, and this is why I previously mentioned that it's important from a legal perspective that it's us setting up the contract, and only afterwards the CCP steps in. We still have the power to determine the price. But if I know that we're going to put the contract through the CCP, I don't really care how risky you are, because I know if things go wrong, if the transaction goes sour, it's the CCP who will have to pick up the bill, and I'm only funding it for 1% basically of the financial resources. So I will try to put the costs on my fellow members of the CCP. But there are some mechanisms that CCPs use to mitigate this risk of moral hazard. Basically, in its very essence, it boils down to that they will only allow members or only allow market participants to use the CCP if they're all pretty much in the same range of riskiness. At least in theory, that is the idea. Let me put it like that. So there will not be little fish that are allowed to directly engage with the CCP. There are pretty high capital requirements and other risk management standards, but still I think the point that you raise is very valid, that there is a risk of moral hazard there.
Okay, so now going back to the original sentence, and so the role of CCPs in markets for OTC derivatives, we know now what the CCP is, the centralized counterparty. We know what over-the-counter derivatives are. What do you research?
Good question, Ben. What do I research? Basically, after the 2008 financial crisis, there was the idea that more of these derivatives should be put through CCPs. And in the EU, as well as in the US and in all other major jurisdictions where you have strong capital markets, we have developed a very extensive regulatory framework for these CCPs, exactly to try to avoid what you guys were touching upon earlier. What happens if the CCP goes bust, or how can we avoid that the CCP would fail, and then, of course, since we have centralized all these risks, that all these other parties would, by definition, be affected. And so essentially what I do, I look at the regulatory framework in the EU, which is called EMIR, the European Market Infrastructure Regulation. And I basically use an economic framework, that I have developed, or that I I have basically collected existing research on how risks may spread through the financial system that we know from other contexts, and I try to apply it to derivatives markets. And if we, my finding there is that the assumption on which we have built our regulatory framework, which is, as I mentioned earlier, the domino effect, that one big derivative player will fail and will bring down other derivative players that are directly connected to them through these derivative contracts, that is actually not the most likely way in which a crisis will occur in derivatives markets. And then from that point, I try to examine what the implications are for our regulatory framework in the EU, the European market infrastructure, and what adjustments we would have to make if it were true what I argue in my dissertation, that this is indeed not the most likely way in which a macro crisis will develop in derivatives markets. How should we change a regulatory framework if indeed it proves correct what I am arguing, that the assumption on which we have built it might be, I'm not saying completely misguided, but that there might be other parameters that are more important or should come more to the forefront.
So the regulation is currently set up on the idea that the most likely next crisis will follow from one party going bankrupt, and then it will tumble down to other bankruptcies. That's how the regulation is now set up.
That's how that's at least how it was developed after the 2008 financial crisis. But awareness is growing that.
And what is your assumption that the regulation should be based upon?
Essentially, that that it's more likely that all derivative transactions have collateral, so basically assets that can be sold if a party were to go into default. Pretty similar to a mortgage. If you take out the mortgage, the bank will be able to sell the house if you don't pay up. So derivatives also have this type of assets connected to it. And there's actually more evidence that points into the direction that rather than parties that are directly contractually connected to each other, bringing down each other in a domino effect, that parties that face financial distress or need for liquidity will start selling their assets at the same time to free up liquidity. Basically, if a bank does not have enough money to meet its payment obligations, it will sell assets that it has on its balance sheet to free up liquidity. But if this occurs on a very wide scale, for instance, because of derivative transactions, then there are accounting rules that will force all other financial institutions that hold similar assets to also mark down the assets that they hold. And so what makes this type of crisis fundamentally different, because of course, if everyone starts to mark down, then everyone has to take additional losses and start to mark down again. And so it's a downward spiral, basically. But what is essentially different from the domino effect is that this, to a very large extent, functions independently from direct balance sheet connections. So it's just because you're holding similar assets, but not necessarily because you're contracting with other entities that you come in a phase of financial distress and in a financial crisis. And so there are mechanisms, or there are ways to look at this to solve this, and it's more in terms of liquidity, and If we focus more on liquidity, and there's different ways for doing that, or changing our regulatory approach or conception of these problems, that is the thesis that I'm developing in my dissertation, how we could do that in our regulatory framework in the EU.
Right. It seems that we have quite a lot to look forward to then. Thank you, Evariest, for joining us. You have that goed uitgelegd.
Thank you, Ben, and Arthur.